So let's get started learning about candlestick analysis and indecision candles. Now, most new traders learn a little bit about candlestick analysis, but they really don't. What they learn is candlestick patterns. And because of this, most of what they learn is completely useless. Now, I teach a lot of classes on the ABCs of candlesticks, introduction to candlesticks. And what we teach you is about all the different candlesticks, what they mean, what the different patterns are, how you can recognize them in your trading. And if you could become a candlestick expert, I mean, somebody who spends months mastering all this, you might be able to incorporate it into your trading. Because pattern recognition is this memorization, and then you're trying to ultimately interpret the markets based on what this pattern means. Okay. For us in CFD trading, it's really kind of pointless and useless. Now, the standard approach, as I said, to candlestick analysis is basically pattern recognition, which fails to work in real trading. But you also can't skip straight to advanced candlestick analysis without knowing some of the basics. If you don't know the basics, that's fine. I got you covered. So when Forex traders first start out, they usually learn about candlesticks because candlesticks are the buzzword of the marketplace. But again, what you learn is usually useless. They normally see a list of candlestick patterns, and each pattern has a set in stone definition, and that's the only meaning it can have or supposed to have. So you see things like the hammer, the inverted hammer, the dragonfly doji, the bullish spinning top, your bullish engulfing bear, and they tell you when you see this, this is the only interpretation you should apply. And they don't really go in to tell you that it's all just simply interpreting price action, but you have to use it with other tools and you have to understand what the market is actually doing because you can't just trade a shooting star. You can't just trade a bearish spinning top. So this is not candlestick analysis. It is pattern recognition. And for a price action trader, it is completely useless. Actually, it's worse than useless. Thinking about candlesticks just as patterns is counterproductive. It makes you a worse trader and it leads you to make massive mistakes. Why? Giving a pattern a set definition leads to tunnel vision. When you see that specific pattern, you assume that something will happen. You also have invested a great deal of time on remembering all the interpretations and the different types of dojis, what a harami is, what a marabuzu is, what a shooting star is trying to tell you. Okay. It really doesn't help us in our everyday trading. And to be honest with you, this is not how candlesticks work. Candlesticks try to help us interpret price action. So all candlesticks need to be assessed based on the candlesticks around them, but many other factors. So the truth about candlestick analysis, normally people say that a spinning top means a reversal is imminent, which can be true, but that's like guessing 50% right, 50% wrong. However, the same pattern can also mean that a continuation is imminent. It can mean that price is temporarily stalling. It can mean a lot of different things. Thinking of candlesticks as simple patterns is the wrong way to do things. You need to look beyond the pattern and read the story of price. So, what's the story of price? Well, let me explain to you my feelings about price. Because ultimately, price is the only thing that matters. It's the only thing that we can trade on. It's the only thing that's going to give us profit or loss. No matter how many tools, no matter how many indicators, how many oscillators you try to apply, price is random. It's completely random because it's made up based on supply and demand, based on human emotion. Period. The end. So what we're looking for are two things. Number one, we're looking for times when price seems to exhibit non-randomness. And that happens quite often. In fact, a trend in either direction is non-random movement. And we're also looking to interpret or have an interpreter tell us what price is trying to say to us. So the foundation of my trading strategy is reading and understanding the story of price. Reading and understanding the story of price is vital in Forex or CFD trading. It is vital because it allows you to answer one of the most important questions in trading. Who is in control of price? The question has three answers: buyers, sellers, and neither. Being able to accurately answer the question is vital. If you're about to enter a short trade, you need to ask yourself, who's in control? And your answer is buyers. Well, if you're saying the buyers are in control, perhaps selling is not such a great idea. Now, simply put, what does that tell you? The trend is your friend. So let's break down the story of price. If you look at the three highlighted candles, it is easy to conclude that sellers are in control of the markets. One, two, three. Coming off a sideways action, but we have three bearish candles. Now, we're not talking about our sellers in control of the market for the last 2 days. We're talking about here, the sellers took charge. Okay. Now, we could have been in the middle of a long uptrend that was continuing, but at this precise moment, the sellers were in charge. The candlesticks all close lower than they open. They are all created new lows beyond the previous candle's low, and they all had small upper wicks in comparison to the candle bodies. The upper wicks indicate the buyers were unable to push the price up by much. It's a simple reading of the candlesticks, quite obvious. But what does the highlighted candle tell us here? So at this point, the sellers have taken over the market. Okay. Like I said, we could be in just a correction of a longer term uptrend. We don't know. All we know is the sellers have taken control. But then we get this candle. Okay. Whether we want to call it whatever we want to call it, whatever name we want to give it, okay, it's fine. But it's unimportant. We get this candle. What does this candle tell us? It has a short upper wick, a small body, and a long lower wick. This is what we call an indecision candle. The sellers tried to push the price down, but they weren't able. They weren't successful. They pushed it down, but the buyers were able to pull it back up, even make a little bit of high, and then they ended up closing a little bit higher than they opened. That's why we have a green candle. So that's telling us these sellers who had taken control of the markets are now full of indecision. We don't have many other sellers jumping in the market. They're sitting on the sideline because they can't make a decision. So what's an indecision candle? Indecision candles occur when neither buyers or sellers can gain and maintain control of price. They are common. They happen all the time. They're not unique. Okay. So you're not just looking for this odd little doji, if you want to call it, this odd little whatever. It's seeing them where they are placed. But if used in the right way, they can be very powerful. Take a look at the bullish trend. The yellow highlight is a strong trend. There are several bullish candles heading towards an area of resistance. And the big bullish candle tells us that during the highlighted period, buyers were in complete control of the markets. So buyers, buyers, buyers. We're not concerned with here. Now, again, we would want to look and see whether we're coming off an uptrend and this is indecision, whether we're coming off a downtrend. We need to be aware of what is going on in the markets. But now we have an area where we have buyers in control. Whatever had happened in the past, right now we have buyers in control. Now we've added on a little bit more information because now we've added on a support and resistance zone. These are just simply drawn on your charts by using support and resistance. If you don't know how to draw support and resistance levels or how to eyeball support and resistance, how to find support, that's a different class because this is standard support and resistance zones and they're drawn on a chart. Now, what happens is when we get what we call an indecision candle in directly in our resistance zone because price is pushing up, it comes to this resistance zone. Will it be able to push through? This is an area of decision making. And what do we get? We get an indecision candle. So what we're trying to do at this point, we're trying to define down to a very small possible scenario of when you would use these candles. So when price hits resistance, we get the indecision candle forming. That's right here. Okay, so the little green box. So let's break this candle down into a story so that you understand why it indicates indecision. So we have a large upper wick that shows the buyers tried to continue the bullish trend but failed. Sellers took control of the price and pushed it down. So if we understand how our candlesticks are formed, we see here buyers pushed up the price higher than the previous high, pushed it all the way up to here, but they weren't able to maintain it. The sellers were able to pull the price back down. They actually even pulled it lower than it had been, and then it ended up closing lower than it opened. That gives us a bearish candle, a red candle, and it gives us an indecision candle because the open and the close were very, very tight. And also the buyers who should have been able to take control or at least pull up the body of this candle a little bit farther could not. So what it's showing us is we have indecision. Now, this is not saying that people are necessarily selling. It's saying you have 1 or 2 points. When you get all of these bullish candles, you should be having buyers jump into the market. That's what you had here, here, and here. Now, you had for a minute there when the trade opened, the buyers jump in there and push it. But then more buyers were not jumping in there and the market eased back down. So the buyers were getting full of indecision. So the large upper wick shows the buyers tried to continue the bullish trend but failed. Now the small bearish body, okay, that's this little body here. The small bearish body shows the sellers were able to close lower than the open. This is significant because in the 3 candles before this, price consistently closed higher than open. This shows us that buyers are losing the power. Then we have the small lower wick. So we're breaking down this candle. The small lower wick shows us that sellers were not able to gain much ground either. This tells us the sellers are not strong enough to turn price around completely. However, they are strong enough to stall further buyer movement. Now, We have not talked about this being three black crows, three red soldiers. We have three white soldiers. We haven't talked about bullish engulfing and bearish engulf. We haven't talked about a doji, a hanging. We haven't mentioned any of those patterns for candles. All we're doing is using candles, and at this point, support and resistance to understand what price is doing or what the buyers are doing in the market. So altogether, this indecision candle forming right after a strong bullish candlestick suggests that the power has shifted from a decidedly bullish market to an undecided market. While sellers are not in control, neither are the buyers. Now, the other thing you should notice is I haven't told you that we're generating a buy sell signal or a sell signal. I haven't told you whether we have a continuation pattern or a reversal pattern. At this point, we're not making any trading decision. We're simply interpreting what price is saying. But there's one more thing we need to look at. The indecision candle is forming on top of the resistance area. That's one of the things that becomes ultimately significant in making a decision. If you remember, we talked about resistance being a selling area and support being a buying area. So the image shows us three strong bullish candles heading into resistance, and then bam, they really get killed at that resistance zone. Price stalls and we get indecision forming on top of that area. This tells us that the sell area is working. When price pushed into that area, sell orders triggered and buyers could no longer continue up. Now that's the story of price for this chart. And the story gives us a nice little price action trade setup. So how do we use this to set up price? Price action allows you to take many different types of trades: reversals, continuations, range, swings, breakouts, and scalp trades, just to name a few. Now, I don't trade reversal patterns. I personally only trade trend continuation pattern. I want something to tell me that this correction has adjusted and the price will continue in the direction of the trend, because I'm only looking for high probability trades. I want everything else to be thrown out the door and say, don't trade me. Now, a lot of people are reversal traders. Reversals occur quite often, but if you don't know what to look for, you cannot trade them. Reversals are one of the strongest price action setups and one of the easiest to trade. And that's because they occur so often. You can trade this setup exclusively and be a profitable trader. In fact, for years, Forex trading strategies focused on reversals only. However, these days, I trade more price action setups. So reversals come in three parts: the preceding trend, the indecision candle, and the reversal trend. So let's talk about the preceding trend and whether you're trading a continuation or reversal. It is always, always critical that you look at the overall trend. Don't look, now remember, we can only trade from the wall forward. We can't trade back here. We can only trade moving forward. So we have to be able to make a decision when we start to see an indecision candle. When we see an indecision candle forming down in the support zone or the resistance area, we need to make decisions, but we can't wait for 10 candles and we can't go backwards. So what we're forced to do is be able to react based on a strategy or knowledge that we already had. And we use not only the most recent candles, but we also have to look at the most recent trends. So a preceding trend is a strong move for the bears or the bulls heading into the support or the resistance area. Now, I only trade indecision candles when we're coming off a well-developed, nice uptrend or downtrend. Because again, I want to throw everything out the door. I want to look at 20 charts, see, or 20 different, 20 charts, and see these setups often. And 19 of them are going to get thrown out because when I finally get one that's really beautiful, I'm hoping that move my probability of success into, you know, a very high level. But again, if you're employing good risk management skills, even if you have a wrong trade, you've gotten out of it with a small loss. So in this case, we have three bullish candles. The preceding trend is very strong bearish move, indicating there are lots of bears in the market and very few bulls. If bulls were strong, then the price would not be trending down. The preceding trend shows that the bears have strong control of price and they are pushing price down into the support area. The opposite applies for bullish preceding trends, which could show bulls trending towards resistance. Now, in this case, in all of these cases, we don't see the preceding trend and we don't see what's on the other side of the wall. A preceding trend can be formed by as little as one candle. If a candle is strong and covers a lot of price distance, I categorize it as a preceding trend for the purpose of reversal trading. Okay, because I don't trade reversals. I don't care. I don't call this a trend. I call this a freak in the market because there's lots of times that Mario Draghi can open his mouth and send the euro skyrocketing or falling, and a second later it's back to where it was. That's not a trend. It's usually something that's happened. But the preceding trends are simple. If you see a strong move heading into an area of support or resistance, you can consider it a preceding trend. Now, the indecision candle. Okay. A reversal setup will have 1 to 3 indecision candles. The indecision candles need to form on or near the support or resistance area. Now, it's not as critical if the indecision candle is bearish or bullish. It just needs to be an indecision candle and it needs to be in the support or the resistance area. If the indecision candle does not form on or near the area of support and resistance, it is not a valid reversal setup. Why does it need to be on the support or resistance area? An indecision candle is a bullish preceding trend, indicates that buyers are possibly losing control and the sellers may be gaining control. In a bearish preceding trend, it indicates that the sellers are losing control and the buyers may be gaining control. However, an indecision candle does not indicate that price will reverse with any degree of certainty. An indecision candle only indicates one thing: indecision. Now, indecision candle doesn't tell you what's going to happen. It doesn't give you an entry point. It doesn't give you a stop loss level. It doesn't give you a target point. It just tells you that that trend has reached an indecision. The traders have reached an indecision. You cannot take a trade based solely on indecision. The image shows indecision forming between support and resistance. So you get that a lot. I mean, buyers take a breath, sellers take a breath, whatever. You have all of these. They are unimportant to us in this strategy if they're not in the level of support or resistance. So what about when a bullish preceding trend heads into an area of resistance or a bearish preceding trend moves into a buy area? Well, then we get the makings of a high probability reversal setup. But we cannot enter just yet. We need confirmation, which comes as part of a three-part of the reversal setup. Okay. So it's not so simple. You're not just looking for a strong move up and a strong move down and an indecision candle. You're not looking for just the indecision candle to be inside support and resistance. These are the rules you have to follow to get to the next steps. So the reversal trend is the third and the most important part of the reversal setup. This is where we make our profit. After a preceding trend stalls at support and indecision forms, you often see a reversal trend. The image shows a bearish reversal trend forming after indecision on resistance. So in the background here, we can see bullish trend, indecision, move into reversal. So in this case, we saw a transition of power from the bullish preceding trend to a bearish reversal trend, separated by a stall on resistance. So where do you enter the trade though? I mean, that's a whole bunch of iffy stuff there. You know what the reversal trade looks like now. You know that you need to enter after indecision and before the reversal trend. So I'll show you how to use my trading strategy to take trade reversal properly. My trading strategy was built on reversal trading. It has now expanded beyond just reversals. But reversal trading is where it all started. Entering trades does not need to be difficult. Remember, my goal is to keep everything simple. See, my rule of thumb is I'm only looking for high probability trades, but I'm not looking for complicated trades. What I want is complex. I want high probability trades. So I throw out most of the trades. I want very strict rule based decisions, but I also have to realize that close is close enough because you're never going to get everything just perfect. But what needs to be right is your risk management. Okay. Because you can only be so right or so wrong. If your risk management is done correctly, you'll get out of a trade that you made the wrong decision without much of a loss. So here with your reversal trading strategy, you have to get the timing all right. So I explained that a reversal comes in three parts: the preceding trend, the indecision candle, and the reversal trend. You need to enter the reversal trade after part two, the indecision closes. Remember, the indecision candle has to close, but before part three, the reversal trend completely takes off. Obviously, you enter after the reversal trend takes off, it's too late. You've given too much profit at that point. You also need to make sure you do not enter too early, as you could be entering a false setup. Well, that's the difficult scenario. So let's see what we have here. So here we have what we're looking for. And now this is, a beautiful, perfect setup. It does happen in reality. So keep in mind, we can only be trading at the wall here. So we're only making a decision going forward. We have no future candles to make a decision on. So what we get is our what we're calling is the preceding trend. So it doesn't have to be three bullish. It can be five bullish. It can be two very long bullish. Whatever it is that's sending the market in a specific direction. We have our support and resistance areas on the charts, and we get an indecision candle forming directly in our resistance or support area. Now, the fact is, we can't make a decision here, and we're not going to jump in the market and sell. It'd be foolish. It'd be a false signal. Market could just bounce right back up here. But now what do we get? We get a solid bearish candle that breaks and closes below resistance. Now, if we waited for this candle, we would have missed most of the price move. So failed trades happen. There's nothing you can do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for a candle close to get in. But I have tested this thoroughly, and waiting for the closes gets you in too late. So in this image, you can see that the first candle in the reversal trend closing far from support. Okay. So here in this case, we have strong downtrend, an indecision candle. Okay. If we waited for this whole candle to close, okay, we would have never ended, we wouldn't have not entered that market till somewhere about there. That gives us a problem because we're not even assured that we're going to get the profit because it could hit this resistance area and bounce right back down. The problem is this was a huge bullish move. Now, we wanted to take advantage of that and we might have another bullish candle here. So how do we actually decide when we want to enter the market after we have the indecision candle? That's the important decision. So this means if you waited for that whole candlestick to form, you lost a lot of potential profit, which is obviously not good. The key to reversal trading or trading any trading for that matter is getting in at the right time. So how do you do that? So how do we enter a reversal trade? I have tested countless entries methods in the last 15 years. In that time, I have found three awesome entry strategies: entering on new higher low, retrace entries, and distance entries. When indecision forms on an area of support or resistance, you can use the high and low of the indecision candle as the entry trigger point. So we could call this low the entry trigger point. Okay, we put our stop loss at slightly above the high because here we're going to be taking a reversal trade to go down. So when the next candle starts to form and it breaks this entry level, we would then trigger our trade. Stop loss being here. So in the image we were just looking at, the indecision is formed on the resistance area after a bullish preceding trend. So we want to enter a short reversal trade. We set our entry a few pips below the low of the indecision candle and our stop loss a few pips above the highest point of the candle. Now we haven't entered a trade. We've set an entry level, but we haven't entered the trade. In trading, highs and lows are very important. In fact, the highs and lows are more important than the opens and the closes. If a new low is created from resistance, it indicates sellers have taken control of price, which means we want to be short. Our stop loss sits above the high, as a break of that high would indicate buyers have regained control of price. For long trades, you set up your entry a few pips above the high of the indecision, a few pips below the low. This is the simplest form of trade entry, but it's also the most effective. Now that you know how to enter, you also need to know how to set your target. So where would you set your target? Because you still have to set your risk management tools. Targets are also very easy. You need to make sure your target comes before major barriers like the next area of support and resistance. So if you enter a long reversal from support, make sure that your target is just before the next resistance area. The minimum risk to reward ratio I use is 1 to 1.5. You all should be using 1 to 2. This means that my target has to be 1.5 times the size of my stop. If my stop is 100 pips, the minimum size of my target has to be 150 pips. So if my stop is 75 pips, the minimum trade size of my target is 112 pips. So from here, we can set our stop loss. We saw price moving down and giving us our preceding reversal trend, our downtrend. We get our indecision inside of our besides our support level. We place our stop loss just a few pips below the low of that indecision candle. We're not entering the market. This is just the price we want to allocate. We set our entry point at a few pips above the high. When the next candle is formed, if that candle is able to break our entry, that triggers our buy. And we would have set our buy goal target here. And then we would have to calculate our risk to reward ratio to see if we can actually make that trade based on our own personal risk reward ratio. So the image above here, support area, is before my minimum 1.5 resistance. So I skip the trade. If there's a major barrier like the next support or resistance area in the way of my minimum target, I just skip the trade. I always start out with my trend line, then my support and resistance levels, then I look at price action, and finally I look at volume to confirm. Okay, volume should always be your last factor to confirm. If you do not see an increase in volume as you're reaching that entry target, consider not making that trade. And this can be your entire trading strategy. In trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts of trading are not the sort of things that you will intuitively know, but many things are easy. You just have to know what to look for. And on that note, I'm going to thank you very much. If you want to learn more about trading indecision candles, you can contact JM Financial and they'll set you up with a one-on-one trade analyst who will explain it all to you on a personal level and help you with your education. So thank you very much and have a great trading night. Good night now.